Every day in global trade, millions of dollars in customs duties are overpaid. This happens constantly due to assessment errors, misclassified goods, or missing documentation. When a company spots this kind of error on their ledger, the professional reflex is straightforward. They assume that recovering these funds is a simple accounting reversal. You prove the overpayment, and the state writes a check back to the company. But the Indian Customs Act interrupts that process. There is a specific legal architecture designed to intercept this capital before it reaches the corporate treasury. This happens because the statute treats indirect taxes, like customs duties, entirely differently than direct income taxes. The rules for getting this money back are governed by Section 27 of the Act. Think of it as a two-pillar system. The first pillar is a set of strict procedural filing thresholds. The second is an aggressive substantive hurdle. That substantive hurdle is known as the Doctrine of Unjust Enrichment. To successfully extract trapped capital, you have to navigate this statute exactly like a legal algorithm, clearing specific logical gates in a precise order. If you fail to understand this algorithmic flow, the state legally absorbs your corporate capital, and they will do so even when the fact of your overpayment is completely undisputed. This maps Section 27. First, establish standing. You must be the duty payer or the bearer of incidents. Next, the time constraint. File within 1 year of payment, or purchase for buyers. Protest payments have no limit. Finally, claims under 100 rupees are rejected. The logic here is purely practical. The administrative cost of processing the paperwork far exceeds the value of these microclaims. Clearing these initial temporal and financial gates achieves what we can call procedural validity. It forces the government to review your claim. But it dictates absolutely nothing about who actually gets the money. Passing Section 27(1) only ensures the state acknowledges they owe a debt. It does not guarantee that capital will return to your specific treasury. To secure the capital, you have to win the substantive battle, and that battle revolves entirely around a concept called the incidence of duty. In taxation, incidence is the economic burden. In a supply chain, from port to importer to buyer, the initial duty incidence lands on the importer. But Section 28D presumes the importer factored that overpaid duty into the final sale price. Economically, this implies the importer has already recovered the cost of the overpayment directly from their downstream customer. If the importer recovered the cost from the buyer and then also receives a refund check from the government, they are recovering the same money twice. To prevent this, Section 28D reverses the standard burden of proof against the taxpayer. You are legally presumed to have passed on the cost. The government does not have to prove you did. You have to deploy mathematical and documentary evidence to prove you did not. Because indirect taxes flow downstream, the Customs Act treats the original corporate payer with inherent legal suspicion. The law assumes the burden is gone, unless you prove you are still carrying it. This leads to a critical question. What happens to a procedurally valid, on-time refund claim if the importer cannot disprove this presumption? The algorithm routes it to a legally mandated default destination, the Consumer Welfare Fund. As you can see, a valid claim defaults directly into a state-controlled vault. This mechanism is the Doctrine of Unjust Enrichment. It ensures corporate entities cannot profit off over-collected taxes actually paid by the public. To bypass the welfare fund, the claimant must use the evidentiary escape hatch found in Section 27 sub 2. You must provide concrete documentary evidence proving you absorbed the incidents. Section 27(1)A explicitly requires documents like specific sales invoices to trace the exact pricing mechanics and prove the cost was not passed down. And be careful. Showing that your pricing remained uniform before and after the duty was imposed is not legally sufficient to prove you absorbed the cost. There are statutory carve-outs that automatically bypass the welfare fund. The first is for personal use imports. The others include Section 26 export returns and Section 74-75 drawbacks. These flow directly back to the applicant. Section 27 establishes the Consumer Welfare Fund as the standard destination for all validated claims. To recover this capital, you must actively prove that the importer, not the consumer, actually bore the financial cost. Zooming out reveals the complete flowchart of Section 27. Procedural failure is swift. miss the deadline or the minimum threshold, and the claim terminates. Then there's the incomplete claim. You navigate time limits but fail the evidence requirement, dropping into the welfare fund. In this scenario, you proved customs wrong, yet see zero capital return. But a successful claim meets every requirement in sequence. You file on time, establish standing, and deploy precise invoicing data to rebut the presumption of incidence, routing capital back to your treasury. Filing a customs refund claim is a relatively minor procedural act. Securing the capital is a major evidentiary battle regarding the economics of your supply chain. For compliance professionals, invoicing and pricing structures are essential evidence for future tax recovery. Section 27 operates as a ruthless logic gate. It exists to guarantee that correcting a government assessment error never inadvertently enriches a corporation at the expense of the end consumer.